Hi, this is Sandeep Gill from the Aguilar and Gill team. Today we had a great panel discussion with our partners. One, Jonathan Bellezza from Diamond Law Group. Second, with Gus Floropoulos from Federal Savings Bank. Among the topics that we discussed was forbearances and impact on the economy, current and future housing update, mortgages and lending restrictions, and a lot more. So let's jump in and have a look. Hello everyone, and thank you for joining. Let's take a few minutes to introduce ourselves. I'm Sandeep Gill, real estate agent with the Aguilar and Gill team at Coldwell Banker Residential Brokerage. We specialize in Queens, Nassau, and Western Suffolk. Jamie?
Hey, what's going on, everybody? Jamie Aguilar here with Coldwell Banker Residential Brokerage, the Aguilar and Gill team. And we're happy to be joining Jonathan, Gus, our preferred attorney, one of our preferred lenders, and just kind of give you an update on what the market is going through in the last 30 days or so. And now we're going into phase two of opening. So we want to touch base upon some of the pros and cons of this new phase that we're going into.
All right, thank you. Jonathan?
Yes, sir. Jonathan Bellezza from Diamond Law Group. I am one of the partners here. We have 3 attorneys, 15 paralegals. We have 2 more attorneys starting in September. We are a growing real estate firm. This is all we do, is real estate closing day in and day out. We don't go to court. We don't do anything like that, just purchase, sell, and lender representation.
Thank you, Jonathan. Gus?
Absolutely.
Gus Floropoulos, Senior Vice President at the Federal Savings Bank. We're a full-service lender and a federally chartered bank. We lend nationally. We have a mix of your conventional and government lending platforms, along with commercial, construction, and various other products.
All right, thank you. So, Gus, I want to start off with you with one of our first questions. Can you talk a little bit about the state of forbearances? And what does this mean for housing market when the forbearance period is up? Should we be expecting foreclosures amidst the job market not fully recovering at that point?
Yeah, so that's a big concern, I think, for a lot of people in real estate. Forbearance is a tricky component because it's not hurting people's credit profiles as long as when the forbearance period is when it concludes that you continue to pay your mortgage on time. As a lender, we cannot close loans for people in forbearance. So one of the things we tell our clients that own, multiple assets, whether residential or commercial, is that you must be out of forbearance in order for us to close the transaction. So that's been a component that's created some issues and some delays. Forbearance is not a free lunch. You have to pay back that interest that accumulates during the time of forbearance. So unless you really, really need it, and I'm sure a lot of people out there do, but unless you really need it, taking advantage of it is really, in my opinion, foolish. As far as market values, my personal opinion, of course, is that, real estate's not a liquid asset. It's not a stock. You can't buy it and sell it in real time in a sense that you could actually affect valuations. I think residential real estate in our geographic area and the demographic that we serve, I think it's going to actually go up in price. We're seeing that. We're seeing a huge surge of new buyers coming from the boroughs, looking to come out to Long Island, looking to go to Jersey, looking to go to Pennsylvania, Connecticut. I even have a client of mine from the Bronx buying a house in Massachusetts. So, certainly the pandemic shifted people's psychology, but adding to that, the protesting and some of the rioting and looting that came with that in the boroughs, especially, is pushing people to really not want to be in the urban areas. So Long Island is definitely going to benefit from that as far as that's concerned. And as far as the actual market values, I don't think residential real estate is going to feel a downtick in our region. Commercial real estate is a completely different ballgame. Retail is, it's already getting hammered. I get about 5 to 10 retail properties on my radar that are, in a default. Their tenants are not paying. The tenants are not going to be paying, and there will be a domino effect in that, that part of the real estate market. Certainly retail, hotels, without a doubt, are going to be hurt the most. And then, multifamily real estate, which traditionally was the safest, for investors and for lenders is going to shift, especially in the boroughs when with the current mayor and governor and their policy towards landlords and rental freezes and really the vacation of paying rent for as long as they feel is necessary. That hurts property owners that need those rents to pay their mortgages. So we'll see how that shakes out over the next few months.
All right, great. Yeah, thank you for that insight. So the next item I want to move on to is the current market conditions. April, May market activity closings, and Jamie, I believe you had compiled a few stats for us to share.
Well, I was recently looking at Nassau County and Suffolk County specifically, which is where we do a lot of our business. And I was looking primarily at properties that just got listed and what's gone into contract over the last 30 days as things begin to evolve into the current situation. Nassau County over the last 30 days has seen 715 properties go into contract over the last 30 days.
Wow.
And Suffolk is really booming. They've put 1,178 properties into contract in the last 30 days. I know Suffolk market, obviously the prices are a little bit on the lower side as compared to Nassau. So I could definitely see where buyers are taking advantage of that. Obviously the low interest rates and products available for, properties under, $510,000 is really dictating where buyers are spending their dollars. And also over the last 30 days, we've started to see the increase in properties getting listed. Suffolk, there was 1,283 properties that got listed over the last 30 days. I'm sorry, that was Nassau County. And then Suffolk has seen 1,444 properties get listed in the last 30 days. So definitely a huge increase over what April and half of May looked like. Obviously the weather's starting to change, and a couple of the properties that I just put into contract happen to coincide with the fact that families are transitioning into other markets around the country, and they're moving their kids out of the school district, and they want to get them situated in a different area, obviously over the summer. So that's going to really dictate what the next couple of months looks like. It's definitely going to get busy for us.
And I think the relaxation of the restrictions that the state has put in is also contributing to all these listings and activity in the real estate market.
Right. Obviously, you and I, we've been touching base with a lot of our seller clients who were thinking about listing in the springtime, and they're definitely becoming active. I have people that have a property here in Nassau County, live in Massachusetts. And now that the restrictions are easier, they're looking to list their property. So, both of us, we've been communicating with a lot of our clients, and we're getting a lot of that same feedback that they're getting ready to list their properties.
All right, great. Now, Jonathan, are you seeing much of the same that Jamie was just referring to as far as stats goes and stuff?
Yeah, so absolutely. I mean, we're a pretty busy real estate firm on Long Island. So throughout the pandemic, we've been essential. We do represent lenders. We were deemed essential through the Treasury Department. So we've been open, reduced staff, took precautions, of course. But we've been doing closings throughout the pandemic, a lot of them virtually. When we're the seller, when we're the buyer, we have the client come and we take precautions. It's a long document, so we could always do it via Zoom meeting like this, albeit much more difficult to do it via Zoom meeting to explain documents. But yeah, I mean, the market has been heating up. I remained busy through the pandemic due to the pipeline that was already in contract. Again, albeit people were losing jobs and things of that nature that were coming in between. But yeah, I mean, since phase 2 started, I went from this Monday having 15 contracts that I was negotiating to about 30.
Wow.
So it doubled in 4 days. Which we were anticipating. We anticipated. I've been calling it the tidal wave. I said when everything opened, I I've been hearing my loan officers like Gus, other people talking about interest rates, and they remain low. And they're talking about their applications. The applications, pre-approvals are still coming in. So if pre-approvals are coming in, that's future business down the line. And there's multiple news articles about it. So yeah, I mean, the purchase applications are up. Inventory low, and interest rates low. So I just read an article this morning that interest rates are going to remain low in 2020. If that happens, that they're doing it for a reason. It's to stimulate the economy. It's to stimulate the housing market. So yes, I would anticipate a continued tidal wave. I think last season, I mean, I don't know about you guys. I didn't have a slow season in the winter. Thank God. It's been great. But it was busy through January. And, it was great. So I think this summer, we're going to see kind of the same, where our busy months are July, August, and stuff like that. But I think it's going to continue into the fall, because we're going to see the bleed over of people that, like Jamie said, want to close before the school season. But people are going to be hard pressed to do that in this type of market. It's going to be very, very competitive out there. And I think some people that won't locate the home or lose the home of their dreams and have on or whatever, will take time to shop, and we'll just close in the fall or in the winter. And I think it will extend our selling season. If you guys recall, the winter, I mean, the season, the weather was very mild, and I know it's not silly, but I also feel that stimulates our housing market when it's warmer out. It's just better. People don't want to move during the winter. They don't want to do a home inspection in snow. Things of that nature. So I think we're going to see a continued tidal wave, and I think it's going to stay busy through January. It's going to be competitive, but with the right team behind you that moves quickly, I think buyers will be able to navigate the market.
That's great to hear. Thank you. So Gus, moving on to you, I'm assuming you're feeling the same trend that Jamie's been talking about, Jonathan just spoke about. What I want to get into is, what do you think, in your opinion, the future looks like? Right now, we are in recession, right? So what do you think, the future is going to look like for real estate? Is the recession going to be short-lived? Because I'm hearing it's going to be short-lived. Now, I wanted to hear from you, because I know you follow the markets very closely than I do. So can you please talk a little bit about that?
Yeah, so recession, by definition, is just, 2 quarters of, negative growth, right? So, in and of itself, to me, it's not indicative of, like, let's say locally, what we are going to feel. Job loss is really going to be the biggest component, I think, to whether or not the second half of this year and the first half of next year will continue to have the momentum that we're hoping for. Whether you want to call it a tidal wave or whatever, just that general trend and that momentum, which has been really positive. We never stopped working. We've been closing loans throughout the pandemic, and as an institution, we've had record months. I mean, we closed $980 million in loans in the month of May. It was the best month the bank has ever had. Me personally, I'm not going to go into my details, but I've been having an exceptional year. So just look, first half of 2020, I've already met what I did in all of 2019. So at the end of the day, it's very hard to really predict what's going to happen in the future. I tend to be a much more conservative person in my outlook and in my strategy. So, I think it's going to probably, unfortunately, tail off. I think the momentum will tail off. Low interest rates are going to be there to support, key areas of the economy, housing being without a doubt one of the biggest contributors to GDP. But, without employment, there's nothing. People don't have jobs. They don't have money. They don't have money. They're not spending money. And the consumer is going to be a real big part of it. As far as interest rates, it's going to help to create more affordability for a lot of people. There's over $3 trillion in new money that has entered into the economy, albeit a lot of it right now is just in the stock market. That money will flow into the real economy over time. And I think that, the election is going to play a big role. We have a lot of geopolitical things going on right now in this country, and especially in New York. We have a lot of divisiveness, and unfortunately, that kind of plays into the psychology of anybody. A lot of people are just, looking at the world and they're confused. And so as far as my predictions, I think that affordability is the key, right? So if you're at price points that help the average family buy a home, you're going to be successful. Your pool of buyers significantly expands when you're dealing at price points where people can afford them. The multi-million-dollar real estate market is something of a niche, and ultimately, those assets, they're not going to move as quickly. If there's going to be any drop in value, it'll be in that market, in the affordable market. I mean, we just did an appraisal on the file that we're all working on together, and the appraisal came back in over 5% higher than the purchase price. And this was a deal that we were worried that it wasn't going to appraise. I mean, Jamie never worries. Jamie's always very bullish on real estate and has a good pulse on the market. But yeah, it's a component of risk, and I think the future. It's you need to be conservative now. I think, look, it's always a good time to buy real estate to live in, right? It's never a question of, oh, will the market go up? Will the market go down? If you're putting your family in a better situation and you're assisting your tax liability in life by having the deductions that you otherwise wouldn't have, plus you build equity, and over time, real estate always does well. It's always a good investment to own real estate, at least to live in. The question really becomes investment in real estate. Is it a good time to buy, a multifamily property, a mixed-use property, a commercial, retail property? And that question is really something that, personally, right now, I don't think it's a good time.
Okay. All right, great.
Well, and speaking of, the appraisal and the market values, it's a lot about supply and demand, right? So we saw that all of the homeowners that were thinking about listing during the spring season, obviously the majority of them did not end up listing their properties for the obvious reasons. And that has created a huge, huge demand with low supply. And we've actually seen a lot of the appraisals coming in over the past 2 to 3 weeks. They have actually, come in slightly higher than what the properties were listed for. Whether that's going to continue, we have yet to see that. But it was very interesting to see that. And I think that the low interest rates that are being offered right now are going to continue to push that buyer who's been thinking about it and not really pulling the trigger over the past year or so, make that decision. I just had a conversation with someone over the weekend, and I mentioned that one of my clients just got a 2.75 interest rate. And she was like, really? All of a sudden, that conversation turned, really positive, and we'll see if, they decide to do something. But it's really spurring that buyer who still has a stable income and stable job to make that decision and not put it off any longer.
Got it. So, Gus, just going back to you again, I wanted to, in the past 2 months, the credit institutions had put a lot of lending restrictions, because of what was happening in the world. Real estate just opened yesterday. Now we're able to do in-person showing, and I'm doing 2 showings today and another one tomorrow. So there's a lot of business that's coming. So my question is in twofold. A, are the lending institutions easing restrictions, and what type of FHA programs are currently available?
That's a great question. So unfortunately, because of the pandemic and the unemployment that followed, there were significant layers of adjustments that were put into the risk categories of loans. A lot of loans are still not financeable for good people with good credit. So right now, the government stepped in and is supporting the secondary market for mortgages of certain types. So obviously the FHA being the first component, but also the conventional Fannie and Freddie pools are also being supported. And that's why interest rates are as low as they are. In the jumbo market and high balance market, the FHA about 2 weeks ago got the servicing support by the Fed, and that allowed for interest rates to improve, specifically on the loan that we're closing today. That deal was not priceable for a period of time. Nothing to do with anything Dan did right or wrong. It's just not a loan that can be priced. There was no demand for it in the secondary market. We're going to continue to see that easing. I think it will be slow in the sense of non-QM mortgages. Those programs are gone, you know, and so certain loans are just not doable. And I don't think it'll get worse as far as restrictions. I think that, you know, lenders were ahead of the curve, and they saw the signs of the unemployment and businesses closing, and they made certain, you know, changes that, you know, hurt a lot of prospective borrowers. But what they did ultimately was preserve the integrity of the quality of the loans that are circulating. And ultimately that leads to less damage over the long term. We obviously experienced the credit crisis in 2008 and just poor decision making leading up to that. And so even the federal government's reaction to what occurred and just injecting that money as quickly as they did. Some people felt it wasn't fast enough, but I got to tell you, when you go back to 2008 and think about how long it took before the government took, you know, financial action, you know, that was part of the deterioration of what we experienced. So, unfortunately, a lot of programs are still not back in the mix, and I think it'll probably be 6 months before we see it. The one thing that I will say is that the forbearance component is directly tied to a lot of these programs. Once the forbearance is out of the equation, even with the unemployment not being where it needs to be, we'll see a lot of programs come back into the mix for pricing. I mean, I'll give you an example. Even hard money lenders, institutional hard money lenders that, you know, lend, you know, on large commercial assets, we're not lending. They're still not lending. And so it doesn't matter if it's a 50% loan to value on a $50 million asset in Manhattan. They're not going to lend. They're on pause. They want to see this kind of shake out. And that's where we're at, you know.
Got it. So I want to go to Jonathan, and I want to come back to you. You know, so I have a last question. So Jonathan, in your opinion, what advice would you give for homeowners who are thinking about selling but are on the fence because of this whole pandemic, and vice versa, same thing for the buyers who have been thinking about buying but are on the fence?
I mean, for sellers, we're a very proactive firm. We send a lot of follow-up emails. We do everything in advance that we can. So for settlers, I always give the same advice. First of all, gather your documents. When I do an intake and I send out my retainer, there's documents we ask for. It's in the retainer agreement. We ask for surveys, COs, etc. Those should be taken at the listing phase. I mean, and disclosed to buyers to speed things up. But with regards to the pandemic itself, I mean, first of all, listen to your agent. You guys have guidelines that you have to follow now. You know, I heard today, I didn't actually read them in depth yet, but I heard today from an agent that you have to record yourself sanitizing everything. I mean,
oh, I haven't heard that, but God forbid.
Yeah, I mean, so there's some guidelines that have to be followed. Open houses, you can't have 1 million people in. You have to do one at a time. So, you know, follow your agent's lead. Take precautions. I mean, your health is of utmost importance. But I mean, something that's on the fence, I would say sell now. You know, there's chatter about a second wave and what that could mean for the real estate industry and life in general. Like Gus was saying, and Jamie and everybody else, the prices are still up. The buyers are still out there. Now would be the time. It's always the time. But if you want to avoid a second wave and possibly being jammed up even further, then yeah, now would certainly be the time. And we've all been closing deals during this pandemic, so it's certainly and entirely possible. For a buyer, like Gus said, like Jamie said, I mean, the interest rates are incredible. You know, under 3%, even 3%. I mean, when I bought my first house, I took an FHA loan. I got 3.875, and I refinanced the mortgage insurance off when the rates were dropped back down to 3.875. And I thought it was a home run. I was like, wow, I just saved so much money. I mean, if I would have waited, granted, I would have been paying mortgage insurance at that time. You got 3% interest rate now, that would have been a home run. And to your point, my wife and I are looking to move. I'm expecting another child next month, and we need more room.
We know some good agents.
I was just gonna mention that.
I was waiting for somebody to say it. Whenever I bring it up, and I'm like, I take my own commission, guys. But yeah, I mean, we were on the fence, and I said to my wife, you know, with the whole COVID-19, yeah, I said, let's wait a little bit. Files assets and money, And when we're in a better position, when this all blows over, we'll buy. And then I saw the interest rates drop to 3%. I'm like, so, you know, I'm out there. I'm not gung-ho about it because I don't absolutely need to, but I'd like to take advantage of the interest rate. I mean, it's a home run. It's literally a home run. I say to a lot of people with regards to taxes, it's the same type of methodology. The taxes on a property, if they're too high, that can preclude you from buying it. But if you call a tax grievance company, which we refer one, and they analyze the property and they say, yeah, well, the taxes are much too high. They're over by 10 grand or 5 grand or whatever the case may be. And we anticipate getting X amount off. That may then qualify, well, not qualify for the loan, but change your mind about actually buying the property.
In the future,
yes. Yeah, same thing with interest rates. I mean, if your interest rate could dictate how much you can buy for, and that's an important factor. So if somebody's on the fence as a buyer, like James said, he mentioned a 2.75 interest rate, person's changed immediately. It's a big difference. It's certainly a big difference. And not that they correlate directly, but usually interest rates and purchase prices do correspond when purchase prices or interest rates bounce one off another. Like if the interest rates go up, the prices will drop to attract more buyers because there's less in the market. It's not a direct correlation, but it tends to follow one another.
Got it. Thank you.
It actually is a direct correlation because the interest rates and cap rates move synonymously. And so cap rates by default dictate values of any asset.
Yeah, I guess what I meant is there's other factors that dictate supply and demand of the market.
Yeah, the demand for sure. Yeah.
Yeah, so Gus, same question. Your advice to homeowners and buyers who are on the fence: should they, ride the wave of low interest rate and take advantage of it now, because we don't know what the future is going to look like. Hopefully, it'll be positive, but no one can know for sure.
Sure. This is what I say to everybody that I speak to on a daily basis. If you don't own a home and you're renting, you need to buy a home. There's never a bad time to buy. Regardless of interest rates. That's just an additional incentive. You should always buy a home as soon as you can. It's the easiest way for the mass of the people out there to start building wealth slowly but surely. And with interest rates as low as they are, the affordability index improves significantly. And so it's always a good time to buy a home, put yourself and your family in a more financially stable environment, and build up equity as opposed to, building up other people's equity by paying rent. No question about it. It's always a good time to live in. As far as investments, like I said before, if you have a good opportunity and you're able to pick up an asset at a desirable value and it makes sense to take the risk, then it's a no-brainer. But, at current market conditions, I would be very patient before I started buying, commercial or investment property real estate until I started to see, more stability in the cash flows.
Now, as far as investment property goes, would you favor fix and flip versus buy and hold?
So fix and flip is a little bit different because it's a little, you're not talking about, rental capacity, right? So if you know a market, and, I think everyone on this, day has done a fix and flip or participated to some capacity. You got to know the market. And if you know the area and you know what your costs are, your math should be done correctly. It's always a good time to do a fix and flip because people always need to buy a home. The one area personally as an investor now, not as a lender, but as an investor in fix and flip opportunities, I look for, affordable ranges. I'm not looking to do a fix and flip in the 7-figure range,
of course,
and just try to make all this money because, homes are so expensive. But again, just focusing back on that affordable range, there's different affordable markets, right? It could be 200 to 300. It could be, 3 to 4, 4 to 5. I would say up to 600,000 is really, the sweet spot of affordable real estate. You find the right deal. You got to have a good GC. I usually partner up with a GC and, he puts up his money with me and, the construction costs a lot less and it's done a lot faster. So that's my approach. It's worked for me. And when I have a client looking to do something, that's always the recommendation. But I think fix and flip is a great way to make a quick buck. It's just if you're a first time, person trying to do a fix and flip, you got to be careful because you align yourself with the wrong contractor and the wrong loan program. These loan programs, they're not cheap, right? We're talking interest rates in the 2s and 3s. These fix and flip programs, they kind of start around 7 and they go up, 10, 12, depending on, the risk in the deal, the person borrowing money, where their credit profile and experience is. But that pool of lending is available. So it kind of says something about the risk that lenders are willing to take. When fix and flip lending is available in this market, when post-credit crisis from 2008 till about 2012, nobody was going to lend on a fix and flip. It was the riskiest, type of loan to do. I think it says a lot because a lot of programs that came back post-credit crisis were completely taken off the table in the first week of March as the pandemic started to really take effect in the country and especially in New York.
Oh, thank you. So, Jonathan, any last parting thoughts?
I think we had discussed previously before we started on the Zoom call. What I'd like to point out is I think this is an opportunity for us as real estate professionals to redefine how we operate. And I heard chatter of this months ago, and I've been talking about it for quite some time. But this is the way the rest of the country does business. They do it a lot virtually, at least on my end. For real estate agents, obviously it's very similar. But, for the closing, people wire money back and forth. People DocuSign. People sign contracts that way. They review contracts over teleconferences. So, what I've been experiencing is a lot of, I'm a young guy, as you probably tell. A lot of my older colleagues and whatnot, they're resistant to this and they're resistant to the change and they're not really tech savvy and they're kind of slow to get up on this. So when I see certain attorneys that I jive with that are, I don't want to say younger, but younger tech savvy guys, it just makes these wire and mail away closings that much easier. So I think that this pandemic should be used as a tool for us real estate professionals to redefine the way we operate and make it better for the consumer. Some of these people that aren't doing it this way already should probably not be in the business anymore. So I think that we should use it as an opportunity. And I think most of us are. I think everybody on this call is. And there's a way to make it better for the consumer. And this is the way. And the pandemic was just that everybody needed. People were talking about market correction and what's going to happen. I think, and again, in my humble opinion, I'm certainly not an economist and I'm not a loan officer or anything like that, but I think in my very humble opinion that this was an unintended correction. For the past 7 years, prices have been increasing. For the past 7 years, our real estate market has been excellent. So has the stock market. And this was a real shot in the gut to really correct things. And I think that it'll bounce back and kind of just level off a little bit. Like Gus was saying. So, and again, my humble opinion on this player.
Got it. Thank you, Jonathan.
Final thoughts.
So, Jamie, lastly, any parting thoughts, any questions before we conclude this amazing webinar that we just had?
Well, on my end, part of my success revolves around aligning our business, the Aguilar and Gill team with other real estate professionals such as Jonathan and Gus that are able to, work with us seamless. And we have been very successful at getting our clients to the closing table, whether on the lending side, on the buying side, or on the selling end. And I think that, if there's other real estate professionals who are going to be, looking at this, video conference, one of the things that I would suggest to, all my partners out there is that now more than ever, it's extremely important that everyone is aligning themselves with, professionals out there who know and can get the job done, right? Because I have a lot of colleagues whose deals went awry over the past 3 months, and it involved, not being aligned with a great attorney, with a great lender, title company, so forth and so on. So, all the way to home inspectors. I mean, I was able to get home inspections schedule within 24 hours over the past 2 months. Rather quickly, and it helped me get my offers accepted out there in a very competitive environment. So I appreciate Gus, I appreciate Jonathan, I appreciate our title companies. My partner Sunday Gill is excellent to work with, and I think that's very important that all the real estate professionals and the buyers who are going to be looking at this call and sellers know that, that's how we operate. We operate with top quality people. I can pick up the phone, shoot up a text, make a phone call real quick, try to get some answers to expedite some things that might take a few days to get done if you're not working closely with another professional like that. So that's my piece of thought regarding the way that we're doing business right now. And now that phase 2 is undergoing, I was on a conference call this morning with my brokerage company, Coldwell Banker, and we discussed a lot of the new procedures that have to be done. No, we don't have to record ourselves cleaning.
I thought that was ridiculous. Are you kidding me?
We have to document that open house was concluded. And
what I was thinking, I'm like, how do you even do that? You gotta hold the camera, I don't know,
yeah,
and then disinfect the camera.
Yeah,
we had to document that the property was sanitized after the showing and whatnot. So it's evolving times for everyone, and we're happy to evolve with what's being required of us as real estate professionals out there, and we want the safety of our clients to be top of mind at all times. So we're going to continue to evolve and make things and continue to succeed.
Thank you, Jamie. So, and I just want to echo that, whatever Jamie just stated as far as, putting together a team has been a big success of, the Aguilar and Gill team, meaning, Jamie and myself, because we align with the professionals who have a high standard, and we're able to actually just make a phone call, get a quick update, and get the deal flowing, as opposed to working with somebody that we have no idea and we can't get in touch with them. I mean, there's plenty of stories of that out there. So with that said, I want to thank Jonathan and Gus for coming on this panel discussion and sharing your current thoughts, what the future looks like, and hopefully we'll come out of this stronger than before.
Absolutely.
Definitely will. Thank you for having us.
All right. Thank you.
Thank you guys.
Thanks.
Let's have a great closing later this afternoon.
Yeah, I gotta go. I was actually monitoring my emails. I saw the numbers preliminary come over from the closer, so I'm gonna work those up for the client right now with my paralegal. Let me run.
Awesome. Thank you so much.
All right, take care, guys. Bye.